Before we get started, I just wanted to point out that I have exported today's slides as a PDF and posted it to the home page because I modified these slides quite a bit, but I drew on them, and it might be hard for you to see some of what we're going to review today if you're trying to look at it through Zoom. So if you prefer to just look at the PDF and expand or contract it, you'll find it in Canvas under today's module. And with that, it's 2:30. So it's so lovely out. We all agreed that we're ready to cry because it's so nice. I mean, really, really, really lovely. It's the kind of day that makes you take stock in everything that's keeping you so busy and making you want to just go out and make some vitamin D. And we might have a chance to do that, a little bit more time to do that today, because I actually think this discussion on the underwriting cycles, while it is riveting, I think we can get through it in a reasonable amount of time. And so I think we'll have some time left at the end. Of course, I'll stay as long as you have questions. So if anybody has anything that they want to cover, we can talk about that at the end. And so I'm going to use the slides as the basis for our discussion today, but we are going to go through the end of section quiz questions because I think that's helpful. And we'll also do a quick review of the discussion items because I've had some people request to make sure that we go through the answers to the discussion questions. So this whole chapter is on, the topic is underwriting cycles and regulation. But all of the reporting that you are going to see on the insurance industry when you start to pay attention to it, because now you're all going to be really into insurance because you're going to know so much about insurance companies, you're going to notice that the key topics or the key terms are combined ratio and profit cycles, and that's what we're going to spend our time talking about today. But we begin with an emphasis on just how big the industry is. Oh my God, it is a massive contributor to our country's GDP. When you look at the total premiums by country of direct insurance premiums written, and what we're referring to here when we say direct insurance premiums written, is those premiums that are written direct to the consumer. This does not include reinsurance premiums because, of course, we're just reinsuring the original premiums that were written. So this is just like all of the direct to customer premiums that were written in 1 year. So this is looking at 2017, and you can see that the US, because these numbers are in billions, so the US was over $1 trillion in total world premiums in terms of US companies writing insurance premiums. China and Japan, the UK come in distant. I mean, they're pretty far behind us because we are have a massive focus on insurance in this country. And when you look at the insurance density premiums per capita, I've actually never seen this data point before, but that's pretty amazing that we're at $4,216 in insurance premiums per human being in the US. That's a lot, which tells you obviously that there's a lot of commercial insurance written in the US. As a percent of total world premiums, the US makes up 28%. And as a percent of GDP in our country, it's 7.1. So how, whether or not the insurance industry does well is important on a lot of levels. We rely on insurance to keep us afloat. Insurance companies are sort of a form of an emergency savings fund. When you compare it to how we operate our own personal financial stratosphere in our own worlds, in our own wallets, in our own homes, we need a buffer in case something goes wrong. And insurance companies are part of that buffer. And if they're not in good shape and they can't pay the claims that they've promised to pay, that's a problem. And so insurance companies are important for that reason, but also when you think about how much of the economy they make up, when you're 7.1% of the US economy, you employ a ton of people, a ton. And those jobs are, as I've mentioned before, are really pretty stable. And so when people are considering careers, I know I've droned on about this enough. I've made it the topic of this week's discussion, but I'm really hammering this point because I think there are a lot of folks out there who envision the degree they're getting is really only meant for maybe one or two types of jobs, and it's just not true. The insurance industry wants people with personal finance degrees. And so if this is a topic that you're interested in, you will find open arms in the interview chairs at insurance companies when you're ready to start hunting down a career that you're interested in. So let's start talking a little bit more about this concept of underwriting cycles and the combined ratio, because the combined ratio really dominates this chapter. And the combined ratio is really, it's a piece of whether or not we're in a hard or soft market cycle, and we'll talk a bit about that. But let's first just define what is this combined ratio? What are we even referring to? The combined ratio is the insurance industry's method of measuring how profitable they are before looking at investment income. So it is simply your losses from claims and the expenses for adjusting those claims and running your business divided by your earned premium. So let's break that down a bit. Losses, both the payments that you're making in promise of whatever insurance you sold, also all the lawyers, you got to pay for, court fees, and maybe you've got to hire physicians to do examinations of the claimants. Maybe you've got all sorts of expenses involved in loss adjustments, including the amounts that you're paying to settle the claim. The expenses include all of the executives' fat salaries, all the salaries of the rank and file, their buildings that they operate in, all the conferences they go to, their internet coverage. All of the expenses associated with running the business divided by earned premium. Earned premium. What the heck are we talking about with earned premium? Earned premium is simply the dollars that have already been used up for insurance. So think about this. When you pay your insurance bill for the year, maybe it's, maybe you write a check in January for your full year's worth of premium for your auto policy. So January, you paid $1,200 for the coming year's coverage. So January, February, March, April, May, June, July, August, September, until next year, until December 31st, this is unusual because most insurance policies are for every 6 months, but in this case, we're just gonna say you have a year-long policy. So Jan, December, you pay your bill in January, and that insurance company hasn't earned your $1,200 until at least one day goes by. And they've earned the entire premium, the entire $1,200 has been earned in December, at the end of December. At the end of June, they've only earned half of it. So you could cancel your policy in June, at the end of June, and you'd get a refund of the unearned premium. So any premiums that are covering the past 6 months since you paid your bill, you're not going to get that back. They earned that premium. So when we talk about earned premiums, we're talking about premiums that aren't going to walk away, that if somebody cancels their coverage, they're not going to get a refund. So losses plus expenses divided by earned premium defines the combined ratio. And it's not always the case that a combined ratio greater than 1 is bad news. So let's think about this. If you've got a combined ratio, if a perfectly break-even combined ratio would be 1.0, right? Your losses and expenses exactly equal your earned premium. Huh, sounds pretty safe, because then maybe you make some money on the earned premiums, and that's how you're going to make your money. Maybe. Everybody has a different target that they're going for. Just because your combined ratio is higher than 1 doesn't mean you're unprofitable, because the combined ratio does not cover investment earnings. Your investment earnings are not reflected in the combined ratio. So if it's a higher ratio than 1.0, it doesn't necessarily mean that you've lost money that year. If it's a combined ratio of less than 1, you've absolutely made a profit, unless you, of course, you had terrible investment returns. So if you lost money in the market, you might have to make up for it by doing better with your underwriting results. Because when we say underwriting results, we are not referring to investment results. Remember, we're in two businesses when you work for an insurance company. You're in the insurance business and in the investment business. So let's talk a little bit more about these cycles. Oh, this is a restatement of kind of what we just talked about. Maybe worth repeating. Combined ratio, relationship between premiums versus claims and expenses. One thing I want to point out is we'll see that combined ratios of some, depending upon the kind of insurance you sell, personal lines being auto and homeowners versus commercial lines, maybe medical malpractice, you've got different goals because your insurance lines behave differently because the claims activity is so different. The type of claim that's presented is so different. And so even within two insurance companies, it can be a very different atmosphere. Working for a State Farm or an American Family, you are in the business of big numbers. It's all about scale. Profits are thin and it is cutthroat because it is a dog-eat-dog fight to get each other's customers. And when you are a State Farm, and State Farm, I should look at how big State Farm is right now. And I drank the Kool-Aid there for a long time, so you got to take me with a grain of salt when I talk about them. But State Farm is massive. And they use their massive size to essentially suffocate their competition. They can tolerate a lower amount of profit because they make up for it in their investments. And so when new competitors come into the market, what does State Farm do? They drop their rates because they can. And in fact, I was talking about Lemonade the other day, this new company that purports to be, for social good. They don't use humans as much. They try to use AI, and their prices are supposed to be super low. Well, I went online this morning and got a quote from Lemonade just to see how it would compare to my homeowner's insurance coverage with State Farm. And right now, State Farm is being threatened from every direction by competition. And so their rates are super low. Lemonade can't beat the rate I'm getting on State Farm right now. That doesn't mean they're not going to change it in 2 years, because State Farm can bump up my rate if they want to. But some companies with excess profits absolutely will try to starve the competition of oxygen. It's sort of unfair because it's like you're both underwater, but State Farm's got this massive oxygen tank of funds behind them. And a lot of these other companies just can't sit in the game that long. They've got to leave the table. So even though insurance companies sound nerdy and boring, it is a dogfight. It's a war for clients because they need the growth. It's very difficult to keep growing when you're as big as some of these companies are. So, all right, so this is a super busy slide, but I wanted to make some points here. When you think about insurance industry results, several economic factors drive what's happening in the industry, but really what drives it, maybe more than anything else, is going to be, well, two primary things. One, catastrophe losses, and two, investment results. And so when you see a high number, a combined ratio of 110, 115, 107, these are all signs that the insurance industry as a whole, because by the way, this chart only includes the property and casualty insurance industry. It doesn't include health and life insurance because those lines do not reflect the same cyclical nature that you see with property and casualty. Again, property and casualty is going to be your homeowners, auto, medical malpractice, liability, commercial insurance. It's not going to include life and health insurance. So when you see these big combined ratios, 110, 115, 107, you're saying to yourself, wow, they did really bad in 2000, 2001, and 2002. What happened to drive some of this? I mean, we can look back historically at what might have driven that, but when you see combined ratios that high, you know that either the business was underpriced, maybe their premium volume was down, and their losses and expenses were up. So that can have a huge effect on what was going on with the combined ratio. So down here, you have a combined ratio of below, and this is for the whole industry, all lumped together. A combined ratio of 98.4 suggests that they were making a little bit of money. That's pretty exciting. Insurance companies are like, wow, we've got a little bit of room here to breathe. And at that point, part of what was driving that result is that they were offloading some of their losses to reinsurance companies. And then you can see, holy cow, there's some seriously good combined ratios in 06 and 07, which again means fewer losses for every dollar they took in. They were only spending 92 to 95.7 cents on the dollar in claims and expenses. So they had a little bit of breathing room and so on. So you can see this cycle of combined ratios up and down, depending upon what's happening. And then you can start to weigh in on some of these catastrophe losses. And I think we'll look at a slide that will show you how bad the 2017 losses were for catastrophes over $1 billion. That really was a very expensive year for the insurance industry. Now, a lot of the cyclical nature and some of the volatility in insurance company results comes from changes within the individual companies in their appetite for taking on new business. And so when we look at a low combined ratio, so the years where you see a lower combined ratio, usually that's going to suggest a soft market. And this is a cycle where companies are seeing that they've got some wiggle room. They have some excess cash flow and they want to keep growing, because if you're not growing in an insurance company, you're going to die. And so it's time to either use that excess cash flow to reduce your rates and or relax your underwriting standards. Like, this is interesting because when you think about like your average household, when your average household finds themselves ahead at the end of the month, they're like, what should we do with this extra money? Some people want to blow it and go on a trip. Other people want to save it, maybe put it in cash. Other people want to invest it and make some more money. When you're a business and you find yourself with more income than you have in expenses, you look for opportunities to take that excess cash and invest it. And for an insurance company, the way that they invest that excess cash flow might be, yes, to throw it in a pile with the rest of their assets, but they also are looking to grow. And the best way to grow is to do what's called cash flow underwriting, which is, let's starve out our competition. We're going to use this room that we have in our cash flow, and we're going to buy some business by artificially reducing our rates and or softening our underwriting standards. We just learned in the previous chapter that you've got actuaries who spend a lot of time putting together products, and they set the pricing based on assumptions about the risk that's represented. Actuaries expect you to follow those damn rules. And when underwriting gets lax about it, just to let more people in the door, losses are going to ensue, which is why you will often see this boomerang effect whenever you have what you would call a soft market. Soft market in 04 led to relaxed underwriting standards, reduced premiums. So when you reduce your premium, you're screwing up that fraction, and you're gonna see your combined ratio eke up. Now, depending upon how far you go in the other direction, maybe companies are like, hey, we're still, remember that the stock market was still pretty decent, 05, 06, 07. It was 08 and 09 that it crashed, because that can also have an effect on insurance companies' interest in taking on additional risk. So when I think about combined ratios, and one way to try to remember it, I think of an insurance company and how psychotic they can act when it comes to their appetite towards risk. And so if we're going to humanize an insurance company, I would say when an insurance company has a low combined ratio, they get all, you call it a soft market, and I think of them as being all soft and flirty. They're like, hey, why don't you come on in? We got great rates. We're pretty easy to get along with, and you're going to love it here. And once you get in, you're like, great, this is pretty comfortable. And then pretty soon they're like, wait a minute, we let way too many people into this party. We're going to actually start charging you more. They start being very hard to get along with. Hard markets are higher premiums, tighter underwriting standards. They're not near funded around. They're like, hey, we gotta clean up here, people. We let way too many people in, and we shouldn't have been so easy to get along with. So that hard and soft market cycle has everything to do with trying to regulate growth. And an insurance company's ability to regulate growth is a lot like the Fed attempting to drive economic indicators by changing and targeting interest rates, right? That's an imprecise process. And insurance companies are no different. It's a very imprecise process when they start to use cash flow underwriting as a method for growth. So one of the more interesting pieces, I think, of this discussion is when we look at, well, what exactly do they need for a combined ratio to break even? We know that if we didn't have investment earnings, a break even is 1, right? So if we can't invest money, if an insurance company just puts all of their profits, under a mattress and makes nothing, then a break-even combined ratio is 1. But they don't put their money under a mattress, they invest it. And their approach to investing looks very different depending upon the line of coverage. But if we lump them all together, if we put every P&C company into the same bucket, their in total combined ratio, their break-even combined ratio is 107. So if they were all on the same team, State Farm, Allstate, all the big carriers that do commercial lines, if they were all on the same team and they all operated as one big unit, in total, their break-even is 107, which means that they expect to get, as a team, pretty good investment results. Keep in mind, they've got a huge surplus. We're not just making money on the money that they made this year. We're making money on the money they have in the bank. And they got a lot in the bank. So when you start to break them apart though, so this is everybody. What if we start to look at individual lines like auto, homeowners, commercial? Well, then you're going to see a combined ratio that looks very different depending upon the kind of coverage. If you're a medical malpractice insurance company, first of all, that you're not paying many claims. One of the best coverages to sell is medical malpractice. Because even though you think that it's such a scary line of business to be in, which it might be scary for a lot of reasons, very few juries want to rule against physicians in this country. And therefore, you got a lot of premium dollars that end up being invested for a very long time, because most medical malpractice claims take forever to settle. So this is a very long tail coverage, which means when you take in premium dollars, you can have them slightly more aggressively invested because your time horizon for those dollars is longer. So medical malpractice being a quote unquote long tail coverage implies that their break even is higher. They can hold their breath longer, as opposed to short tail coverages like auto and homeowners. You know, those claims don't take very long to settle. And so we know that we need to target as a break even a lower combined ratio, because we aren't going to be able to leave the premium dollars invested as long. We're going to have to use those to pay claims in a faster fashion. So the length of the tail drives the required break-even ratio, or it sets the break-even for the combined ratio. So again, you can sort of see, the line of coverage, which has the shortest tail, is homeowners, because their combined ratio, their break-even combined ratio at 103 suggests that's, there's just a fast turnaround on homeowners claims. Auto claims, you can think of a lot of the, all of the lawsuits that happen, way more from auto claims than from homeowners claims. And so auto insurance, litigation can go on for years, which is why that tail is a little bit longer. All right, so this other chart, commercial and personal lines, net written premium growth from 1996 to 2018. I just wanted to provide it as a comparison to this chart. And I blocked out, from 2000 before, because I wanted to do a side by side, starting with 2000 through 2018, just to show you how, and obviously you would expect this chart to sort of have the same shape, right? Because you're like, well, wait a minute, of course it's net written premium growth that's going to help drive the change in this ratio. But when you start to pull some of these data points together, you can get a sense of what is a leading and what is a lagging indicator. If you're interested in this kind of data-driven analysis, one of the hugest consumers of analytics and consultants is the insurance industry. You will find so much written about insurance. Specifically, you're going to find all sorts of consulting firms that try to speak to what's going on with the insurance market, because insurance companies are starved for somebody to tell them what will help them eke out just a little bit of better competitive position. And this Willis article I thought was interesting. It's from July, and it's talking about the fact that right now our insurance market is hardening. And I wondered if I would have had you read this article prior to this chapter versus reading this article after you consume this chapter, it will have been like you read, first of all, foreign language, and now it should be native to you, not native, but a little bit more familiar. Because we talk about, in this article, just the shifting goals of insurance companies, as well as some of the changes in insurer attitudes and behaviors that are driving this hardening market. We look at the catastrophe year of 2017, the impact that had, as well as the changes in frequency and severity, the interest rate environment that we're in. All of these combine to drive an insurance company's appetite for taking on risk. I'll put a link to that article in Canvas. I was going to actually have us read it together today, but we've got other things to cover. Okay. So this cute graphic is a quick tour of the horrific year that was 2017. Because each of these represents an event that cost at least $1 billion. And that's a lot of events that were $1 billion or bigger. The funny thing is, none of them by themselves really stand out that much unless, of course, you're from that area. But it's, you know, it's different than when you had like a Hurricane Andrew or any of those individual events that were such, you know, big headlines because it's one single concentrated event. But a year like 2017, that's just sort of, you know, most of us, it doesn't even cross our radar, but that was a terrible year for the insurance industry. And it gives you a sense of, you know, just how easy it is to start racking up a really bad year and why insurance companies need a really big surplus so that they don't go belly up. Okay, so a quick review. Terms that we've talked about, underwriting cycles, which is just referring to the changes in prices over time. Hard and soft markets. Even if I close this, you should be able to tell me what a hard and soft market refers to. Hopefully the visual helped, but to me, the soft market, just simply saying, hey, we have an appetite to dance. We want you, we're gonna be easy to get along with. You can come on in, rates are low, versus a hard market, we're like, hey, we're not very nice. The prices went up and we're getting really strict. And it means we're getting serious about applying our underwriting standards. So soft market, cash flow underwriting, hard market, we you know, we're gonna buckle down and get our act together. Combined ratio, the most universal metric used by insurance companies to measure profitability of their underwriting operations. Does not include investment results. The cash flow underwriting we just talked about. And the break-even combined ratio of the whole industry, what was it? Lucky number 107 is the break-even ratio of the combined industry versus if you start to break it out by line, then we care about whether or not they've got a long tail or a short tail. That really is that's the factor that drives whether or not they've got a higher or lower break even. All right, let's do a quiz. The quick summation, apologize, of the previous section. I've included in the slide just a quick summary of the discussion question summaries, which was covered in all of the quiz questions we just went through. You know, understanding the underwriting cycle is all about pricing changes, and it's usually fluctuations in profit that cause it, but can also be, you know, desire to grow and willingness to take on the risk of sloppy underwriting just to crush your competition. Underwriting cycle is measured with a combined ratio. We really drilled into hard and soft markets, and we saw the impact that catastrophe claims can have on your combined ratio and the cycle, and it's huge. So insurance company regulation, the things to remember from this chapter is that, number one, the states regulate insurance, not the feds, which seems like the most inefficient thing ever. But if you read the chapter, you'll see that it grew out of the fact that most insurance companies were regional, and the risks that they insured were very different depending upon where they're located. So there's some arguments both for and against whether or not insurance should be regulated at a federal or a state level, which is really interesting because when you think about how massive some of these insurance companies are, it's hilarious that their state regulators are responsible for regulating them, but whatever. So the types of insurance regulatory laws revolve around licensing of both insurance companies and agents, making sure that insurance companies stay solvent, because that is the number one goal. The number one goal of regulation is to make sure that insurance companies stay solvent. They need them to function and operate effectively. And if they don't, there will be consequences. And each state is a little bit different in how they approach it, but there might be liquidation, there might be rehabilitation. And there's oftentimes a requirement to be reporting to the state insurance department on a regular basis so that they can make sure you're going to stay solvent. And the rating system that you use to price your business, because every year you come up with rates for your auto, your homeowners, your medical malpractice lines, and you have to file those with the state insurance commissioner's office. And they approve those rates. Every state's a little bit different. Some of them you just file the rates and use them until they tell you you can't if they don't like them. Some you have to get pre-approval. So again, it can feel a little bit inefficient, but the rates that you charge, they want to make sure that they're going to be adequate so that you're not going to go belly up because they want you to stay solvent. They also want to make sure that you're not using unfair trade practices, and they deal with all sorts of other regulations, but those are the key ones that I wanted to focus on. They have the power to grant, deny, and suspend licenses for insurance companies and insurance agents, to force you to report to them annually, to examine your business, to investigate complaints, to review your rates and review the contracts that you use. Most customers don't know this, but if you ever have an issue with an insurance company, if you're going to have a problem with a company, it should be an insurance company, because I'll tell you, the insurance commissioner's office will force the insurance company to respond to you quickly. One of my functions, one of my responsibilities when I worked for State Farm was when somebody had a complaint for one of my agents, I was responsible for investigating and making sure that we responded back to that client in speedy fashion. Because once the complaint is received, the clock started ticking and we had to meet or beat the expected response times. It didn't mean that we had to pay the claim or, fold like a lawn chair for the complaint, but we had to deal with it quickly. And every insurance department is a little bit different, but investigating complaints, if you ever have a problem and you're not getting satisfaction with your insurance company, write a complaint to the insurance commissioner's office, and they will drill that to the ground until you get at least a response. So that is one of their functions, in addition to rate review and making sure that the contracts that you're using follow the prescribed standards that the state has. There's another one I wanted to talk about. Where is it? Oh, here's good news. I couldn't care less about the risk-based formula for life insurance companies. Just know that it exists, that we care that insurance companies don't take on too much risk with their life insurance investments, because we need them to be solvent to pay life insurance claims. Same thing with property, casualty, and health insurance. Everybody has a different level of risk-based capital that they can't exceed, and that the insurance department can take action if they aren't where they need to be. If somebody's taking on more risk than they should with their underlying investments, the insurance department will not be happy because they're afraid you're going to go belly up. They don't want you to do that. Because if you do go belly up, that means that you might trigger the guarantee fund from kick in. Now, this is important for you to understand, for those of you especially that are going to be working one-on-one with clients, is that insurance companies all are forced to kick in to this guarantee fund for each state. Every state has their own guarantee fund. And if you want to sell your products inside that state, you will pay, and this is one of your expenses, is to make a contribution to the state guarantee fund in proportion to the premiums that you write in that state. And what happens then is if one of your competitors goes belly up, the guarantee fund will step in and help pay the claims of the insured that just got hosed because that company went belly up. Agents are not allowed to use this guarantee fund as a way to induce a purchase. But when I'm explaining to somebody about an annuity, for example, an annuity is not a bank product. An annuity is an insurance product. And annuities are gaining traction because they're guaranteed insurance contracts. Well, if they're sold by a schlocky company, like, well, what if that schlocky company goes belly up? Is it still guaranteed? Well, a portion of it is guaranteed by the State Guarantee Association. So if you're a poorly managed company, if you're ABC Life Insurance Company and you sell annuities and you have a terrible financial strength rating, you're gonna have a hard time getting people to buy your products. Now, the agents are dying to tell their prospective clients or customers that, hey, but we've got this guarantee fund. It'll back us up, don't worry. You're not allowed to do that. But if you're a financial advisor and you're not selling products, you can talk about that guarantee fund. There's limits to what it will pay out, but there is a guarantee fund. The rest of these, the other things to keep in mind is that agents' activities when it comes to selling products, there are rules against rebating, churning, twisting, anything that you might do that sort of takes advantage of the client's lack of knowledge. And certainly, if there's some kind of a conflict of interest, you can be assured that there is an insurance regulation against it. So when you look at this chapter, those are the things that I want you to really take away from it. We talked, I feel like I have to give, state insurance departments a fair shake in terms of, career trajectories. Somebody could maybe have a nice career working inside of a state insurance department. Good, solid, government job. I personally think that you'd be better served starting working for an insurance company, but there are interesting positions within certain state insurance departments. Not all of these departments are very big. Obviously, it depends on the state. All right. I'll let you go through the quiz for this chapter yourself. It's not as riveting as the previous chapter or previous section. But those are the things that I wanted to cover for chapter 8.